Current trading action for MicroStrategy Inc. Class A, MSTR, is showing significant pressure on the tape right now. We are looking at a live price of 200.58 USD, which represents a decline of 6.22 points, or roughly 3.01% down for the intraday session so far. If you're watching the charts, you are seeing a continuation of the volatility that has defined the stock for the last several quarters. But the specific price action happening at this very moment tells a much more complex story than just a red percentage sign. Most investors looking at this drop are seeing fear. They see a stock that has come off its highs and assume the Bitcoin bet is failing, or that the leverage is finally biting back. That is the expectation, that MicroStrategy is simply a high beta proxy for Bitcoin that bleeds when the crypto market sneezes. But the reality, the situation effectively unfolding on the order books right now, is far more mechanical and arguably more interesting. What we are witnessing is not necessarily a failure of the underlying asset. Bitcoin is still holding significant levels, but rather a compression of the premium. The air is being let out of the valuation, bringing the stock price closer to the raw net asset value of its Bitcoin holdings. This isn't a panic. It is a repricing of the company from a software stock with a treasury to something that the market is now treating almost exactly like a closed-end fund. This distinction is crucial because it changes the entire thesis of why you would own this over the spot asset itself. When you open your Robinhood app or look at your dashboard on SoFi Invest, you're presented with a simple line chart. But if you were to pull up the institutional terminals used by Fidelity Wealth Management or the analytics tools available on Interactive Brokers trading platforms, you would see that the volume profile today is heavy on the sell side. Yet, it is being met with very specific algorithmic bid walls. This suggests that while retail traders might be capitulating due to the headline drop, there is a rotation happening where deeper pockets are stepping in to arbitrage the spread between the stock price and the Bitcoin it represents. Let's strip this down to the core argument that is causing this volatility. The common ground that everyone agrees on is that MicroStrategy is essentially a leveraged Bitcoin play. You buy Tesla stock if you believe in EVs and AI. You buy NVIDIA stock if you want exposure to the chip infrastructure. And you buy MicroStrategy if you want Bitcoin exposure with a kicker provided by Michael Saylor's debt strategy. That is the standard belief. However, the contrarian take that is forcing this price down to the $200 level today is the fear that the infinite money glitch, the strategy of issuing convertible debt to buy Bitcoin, which raises the stock price, allowing for more debt issuance, might be hitting a mathematical ceiling. The market is testing whether the company can continue to issue debt at attractive rates if the stock premium evaporates. If MSTR trades at the value of its Bitcoin, the accretive value of issuing new shares to buy more coin diminishes. This feedback loop is what is being stress tested in real time right now. If you look at the intraday swings today, you will notice that the correlation to Bitcoin's minute-by-minute moves has actually decoupled slightly. Usually if Bitcoin spikes 1%, MSTR spikes 2%. Today, Bitcoin has remained relatively resilient, yet MSTR is down over 3%. This decoupling is the market expressing doubt about the premium. It is a very rare occurrence and usually signals a local bottom or a fundamental shift in investor sentiment. For those of you using Schwab Intelligent Portfolios or similar automated systems, this kind of volatility can often trigger rebalancing events, which adds more selling pressure mechanically, regardless of the fundamental outlook. It's a cascade effect. Volatility begets volatility. To understand why this $200.58 price point is so critical, we have to look at the volume. We are seeing elevated trading volume today, significantly higher than the 30-day average. When a stock drops on high volume, it usually means a changing of the guard. The early believers who bought in strictly for the leverage are exiting, likely rotating into spot ETFs or even Apple stock as a defensive play, while a new class of investor, volatility arbitrageurs, is entering. These are players who don't care about the long-term vision of Bitcoin as a reserve currency, but are strictly trading the mathematical spread between MSTR's volatility and the implied volatility of the options market. This brings us to the broader ecosystem. Retail access to these kinds of sophisticated trades has never been easier. Whether you are using Robinhood stock trading to buy fractional shares because a $200 price tag is still optically high, or you are utilizing Webull or SoFi Active Investing to trade options, the retail crowd is heavily involved here. In the past, this level of complex arbitrage was reserved for hedge funds. Now we see Robinhood fractional shares data indicating that retail investors are trying to buy the dip, but they are fighting against a massive institutional repricing. It is a tug of war between the HODL mentality and Wall Street's risk models. Let's take a step back and analyze the company itself, because amidst all this financial engineering, it's easy to forget that MicroStrategy is in fact a software company. Founded decades ago, their core business is business intelligence, BI. This is the engine room. While everyone focuses on the Bitcoin treasury, the flashy hood ornament, the BI business is the transmission. It generates the steady, boring cash flow required to service the interest payments on some of the debt. Without this operating arm, the company would just be a holding shell. The software division provides analytics and mobility software to enterprise customers. It's a mature business. It's not growing like a startup, but it is sticky. Clients who use MicroStrategy for their enterprise reporting tend to stay. This cash flow is what allows Michael Saylor to sleep at night. It provides a floor, even if the crypto market enters a winter. The software licenses keep the lights on, and the bond coupons paid. Historically, the company was a steady, if not somewhat unexciting tech stock. The pivot in 2020 to adopt the Bitcoin standard changed everything. It was a binary bet. Management looked at their cash reserves, saw them melting away due to inflation and lack of yield, and decided to convert the treasury into the hardest asset they could find. Since then, the stock has ceased to trade on software earnings multiples and started trading as a function of its Bitcoin per share metric. This metric is the North Star for the company. Their goal is to increase the amount of Bitcoin backing each share of stock. They do this by issuing equity when the stock trades at a premium to buy more Bitcoin, effectively accreting value to existing shareholders. It is a brilliant strategy when it works, but it relies heavily on the market willingness to pay that premium. Now, look at the current landscape of online investing. Investors today have choices. Back in 2020, MSTR was one of the few ways to get exposure to crypto in a traditional brokerage account. You couldn't just buy a spot ETF. Now, you can open your Fidelity brokerage account or your Interactive Brokers trading platform and buy a spot Bitcoin ETF with zero management fee complications. This competition is part of the reason we are seeing the price compress today. Why pay a premium for MSTR when you can buy the asset at par via an ETF? The answer has historically been the leverage and the lack of management fees on the Bitcoin stack itself. MSTR doesn't charge you a 0.25% expense ratio to hold the coins, but as the ETFs become more liquid and options become available on them, MSTR loses some of its scarcity value. This competition for capital is fierce. Fidelity Investments has been aggressive in rolling out their own crypto products. SoFi stocks and crypto platforms are integrating these assets seamlessly. The moat that MicroStrategy had, being the only liquid vehicle, is gone. Now they must compete on performance, and that performance comes from the intelligent use of leverage. This is where the reality part of our analysis gets deep. The drop to $200.58 suggests the market is worried that the leverage is maxed out. If they cannot issue more debt, they cannot buy more Bitcoin. If they cannot buy more Bitcoin, the accretion stops. If the accretion stops, the premium vanishes. It is a precarious position, and that is what the bears are betting on today. However, there is a counter-argument, and it's one that could reverse this trend rapidly. The short squeeze potential in MSTR is always lurking. Because the company is so heavily shorted by those hedging their Bitcoin exposure, any positive catalyst, like a regulatory shift or a sudden spike in Bitcoin price, can force these shorts to cover. We have seen this happen with Tesla stock time and time again. The shorts get comfortable, the valuation looks stretched, and then suddenly a wave of buying forces a squeeze that defies logic. With MSTR trading down 3% today, the shorts are profitable right now. But if Bitcoin ticks up even 2% or 3% later in the session, those profits can evaporate, leading to a scramble to buy back shares, which drives the price up vertically. Let's consider the role of the broader financial ecosystem. Schwab Intelligent Portfolios and Fidelity Mutual Funds are increasingly looking at crypto-adjacent equities for their diversified funds. MSTR often finds its way into growth or tech ETFs because of its sector classification, not just crypto funds. This passive flow is a massive undertow that supports the stock price. Even if active traders are selling, the passive index funds buy automatically, as long as the market cap remains significant. This structural support is often overlooked by the retail trader on the Robinhood app who is just watching the tick-to-tick charts. We also have to talk about the